Hello, knowledge seekers. In this episode of 20-Minute Books, we dive into Mastering the Market Cycle by Howard Marks, a profound exploration aimed at demystifying the financial market's often misunderstood and overlooked aspects, its cycles. Published in 2018, this insightful book reveals the nature of financial cycles, their behavior, influences, and most importantly, how to strategically position oneself within these cycles to navigate risk and adapt to the market's current state. Howard Marks, an esteemed American investor, writer, and co-founder of Oaktree Capital Management, brings his vast experience overseeing more than $122 billion in assets, alongside his highly acclaimed ongoing series of memos, valued by renowned investors including Warren Buffett. Mastering the Market Cycle, Marx's second book, serves as a much-anticipated sequel to The Most Important Thing, offering a deeper understanding of market cycles through the examination of past financial events and the lessons they impart. This book is an essential read for anyone in the investment realm. Whether you are an aspiring investor pondering on how to select your assets, an individual who has already ventured into investments, or an investor seeking to sharpen your competitive edge, by encapsulating the essence of financial cycles, their impacts, and strategies for optimal positioning, Howard Marks equips readers with the knowledge to make informed decisions in the ever-changing landscape of the market. Join us as we uncover the keys to mastering market cycles and enhancing your investment strategy. Mastering the Market Cycle, Getting the Odds on Your Side. Introduction: Riding the Waves, Master Market Cycles, and Elevate Your Investing Game. Imagine you're at the helm of a thriving financial investment firm, armed with over 4 decades of market experience. Picture the scene. Clients flock to you, hungry for advice, their queries echoing a common theme: the elusive market cycle. They're all seeking insights into the same questions. Where do we stand in the current market cycle? Are the markets flourishing or floundering? How can we navigate this cycle to our advantage? This narrative isn't just a flight of fancy, it's a day in the life of the author, a seasoned investor who's seen it all. And through his lens, we're taken on a journey into the heart of market cycles, a concept that remains misunderstood and underappreciated despite its critical role in investment success. By delving into the nuances of market cycles, you'll be equipped with the knowledge to elevate your investing prowess. Throughout this journey, you're set to uncover the strategic merit of going against the flow in the financial realm, the inevitable dance of boom and bust cycles, and the paradox where markets deemed risk-free harbor the greatest dangers. Embrace the insights from a master of the market. Unlock the secrets of market cycles and stride towards becoming a superior investor. The keys to mastering these cycles lie within your grasp, ready to transform your approach to investment and guide you to unparalleled success. Part 1: The Savvy Investor's Quest: High Value at Low Cost. Imagine stepping into the shoes of an investor whose daily conquest is to amass assets that promise high value at a bargain. This investor meticulously curates a portfolio, a collection of investments, each selected with the hope of blossoming in value over time. However, here's the catch: the crystal ball of investment outcomes remains forever cloudy. No investor possesses the magical foresight to predict with certainty which investments will prosper. The path to success, then, is paved with educated guesses, a skill that demands both discipline and a keen analytical mind. Confronted with the daunting task of foreseeing the distant future, the investor soon realizes a hard truth. It's a fool's errand. When it comes to large-scale economic, geopolitical, or market events, think wars, stock market crashes, or groundbreaking technologies, one's predictions are no more reliable than the next investor's. After all, isn't everyone reading the same reports? Analyzing the same data? This realization brings us to a pivotal point: the wisdom in focusing on the knowable. Rather than gazing into the crystal ball of long-term forecasts, a prudent investor zeroes in on tangible present facts that shed light on an asset's true worth. Take a company's stock, for example. A shrewd investor analyzes the company's tangible assets, comparing their intrinsic value against the stock's market price. An undervalued stock price in relation to the company's real worth might just signal a golden investment opportunity. The underlying strategy is straightforward yet powerful. Purchase assets at a low price, then patiently await the market's inevitable fluctuations to raise their value. Consider a scenario where the real estate market has plummeted. Developers, burdened by debt and forced to halt construction, might be willing to sell properties at a loss. An investor clever enough to recognize the inherent value of these properties, perhaps even in their raw materials alone, could secure a profitable deal. Many investors view this buy low, sell high philosophy as the entirety of their strategy. However, according to the author, there's a crucial third dimension at play: the financial cycles. Navigating these cycles with acumen and timing can elevate an investor from good to great, placing them well ahead in the game of wealth accumulation. Part 2. Deciphering the enigma of market cycles. Let's unwrap the concept of cycles, shall we? According to the sage insights of the author, a cycle is essentially a pattern of repetition. Nature, the grand conductor of cycles, showcases this rhythmic dance with day melting into night, only for night to unveil the day once more. Seasons flow in a perpetual loop, spring to summer, summer to fall, and fall to the chilly embrace of winter, before the cycle renews with the warmth of another spring. The beauty of these natural cycles lies in their predictability. This reliability allows us to orchestrate our lives with a degree of confidence, positioning ourselves to leverage these patterns to our benefit. Venture into the realm of markets and economies, however, and the predictability fades into the background. If the natural world's cycles are like a clockwork ballet, financial cycles are more akin to an improvisational dance, unpredictable yet undeniably present. Imagine, if you will, an Earth that doesn't orbit the Sun at a consistent pace. Its speed fluctuates unpredictably, throwing our concepts of day and night into disarray. Similarly, market cycles ebb and flow with no fixed rhythm, making the transition from economic booms to busts an uncertain voyage. While we can't pinpoint financial cycles with the same precision as we do the sunrise, we can identify certain tendencies. A tendency in this context is what an astute investor perceives as probable, along with their best guess at how likely it is to occur. Consider this: after a buoyant market boom, where prices soar to dizzying heights and investor spirits ride the wave of optimism, a bust is almost imminent. Prices plummet, optimism turns to pessimism, and the market mood darkens. Predicting the exact moment of the shift and its severity, however, remains a gamble. Yet, this unpredictability doesn't render investors powerless. Facing a market bubble, a savvy investor can position their portfolio to weather the impending storm. The mechanics of the boom-bust cycle and its implications for the astute investor form the essence of our next exploration. Part 3. Unraveling the tapestry of market cycles. Short-term fluctuations within long-term growth. Diving into the complexities of market cycles, we find wisdom in a saying often attributed to Mark Twain: "History doesn't repeat itself, but it certainly rhymes." This aphorism rings especially true for the cyclicality of financial markets. While each cycle is unique in its unfolding, they all share a chorus, echoing similar patterns of rise and fall. To appreciate the rhythm of these financial cycles, let's examine a landmark event: the dot-com bubble and its implosion between 1995 and 2002. This period serves as a stark illustration of a boom-bust cycle, largely fueled by the exuberant, often reckless, investments of venture capitalists. In the 1990s, the explosion of internet usage in the United States signaled vast opportunities for profit. Venture capitalists, drawn by the siren call of this digital frontier, eagerly funded a plethora of online companies. Like mushrooms after the rain, these businesses proliferated, despite many displaying scant potential for profitability. Caught up in the euphoria, the stock market surged to dizzying heights, with venture capital returns soaring into the triple digits. This gold rush drew in more investments, oversaturating the market with internet companies. A bubble was inflating, ready to burst. And burst it did, as the unsustainable bubble collapsed, sending many venture capital portfolios into a tailspin, with losses mounting to 100% for many investors. The once lofty stock prices plummeted, marking the harsh conclusion of the bubble era. Graphically, this tumultuous period would depict a sharp, cathedral spire-like ascent in venture capital investment around 1999, reaching its zenith in 2000, only to descend precipitously within that same year. Yet, the story didn't end there. Venture capital investment has, over time, recouped much of its former glory, albeit at a more measured pace. Today, investment levels approximate half of their peak in 2000. This encapsulates the dual nature of market cycles. Over the long haul, markets tend to exhibit secular growth, a steady, persistent increase over years or even decades. However, this long-term growth is interspersed with short-term oscillations, where growth spurts and contractions dance around the underlying secular trend. The vivid illustration provided by the dot-com era offers a microcosm of the broader market dynamic. While markets generally trend upwards over time, their journey is punctuated by periods of volatility and fluctuation. Let's delve deeper into the causes behind these short-term gyrations in our next exploration. Part 4. Navigating the emotional tides of market fluctuations. Daily life, for most of us, unfolds in a relatively stable emotional landscape. Sure, we have our ups and downs, but extremes of joy or despair are the exception rather than the rule. So, it might come as quite the revelation that the heartbeat of short-term market movements often pulses to the rhythm of human emotions, oscillating between the highs of greed-fueled euphoria and the lows of fear-driven despair. Here's the narrative that plays out in the financial markets. Consider the heady days of the late 90s when venture capital was fueling unprecedented growth. Investors, caught in the euphoria of the moment, began to believe that the boom was infinite. This belief, often born out of a lack of experience or an overconfidence in the newness of the market, led them to dismiss the cyclical nature of past market performances, declaring, "This time it's different." Euphoria, like a contagious virus, spreads rapidly, luring more and more investors into the fray. Prices soar, often well beyond any reasonable benchmark set by long-term trends. Investors, driven by a fear of missing out or simply unaware of the potential for a downturn, continue to pour money into the market. Then, a shift occurs. The cloud of fear descends as investors begin to sense that prices have ascended too high, too fast. They initiate a sell-off, which, like a chain reaction, prompts others to follow suit. As a result, prices plummet, often dipping below the long-term trend line, sucked downward by the vacuum of collective panic. Resisting this tidal wave of herd mentality proves immensely challenging, even for the brightest minds. Take, for instance, Isaac Newton, a man whose brilliance is undisputed, who found himself swept away by the currents of market emotion. Despite his intellectual prowess and financial knowledge, Newton couldn't resist the lure of the South Sea Company's stock, which ballooned and then spectacularly burst in the early 18th century. Initially, Newton sold his shares, wisely reading the warning signs. However, as he witnessed his contemporaries amassing fortunes, he leaped back in, buying at the peak only to suffer staggering losses in the crash. Newton's experience underlines a crucial investing strategy. Steering clear of the herd's influence during times of greed-induced euphoria is just as vital as avoiding the despair that drives panic selling. But how does one maintain such steadfastness in the face of market mania or panic? The ensuing discussion will shed light on overcoming despair, driven fear, an endeavor equally critical to the savvy investor. Part 5. The counterintuitive wisdom of investing. Risk perception versus reality. In a world where financial markets are as changeable as the weather, countless investors find themselves glued to media reports, trying to decipher the market's every whim and whisper. Yet, a significant number overlook a crucial aspect of investing: understanding their position within the cyclical ebb and flow of the investment landscape. Enter the realm of the superior investor, a domain where acute attention to market sentiment and cycles separates the wheat from the chaff. It boils down to a seemingly paradoxical truth. When the market buzzes with euphoria, when investors throw caution to the wind in a greedy rush, that's when the specter of risk looms largest. Precisely when the crowd chants, "The market is invincible," or "This time is different, danger is at its peak." It's at these times that returns on risky investments shrink, swayed by the fervent buying that allows sellers to command sky-high prices and offer paltry risk premiums. Conversely, let's visit the aftermath of a market downturn, a period shrouded in pessimism and fear. Here, amidst the desolation left by a crash or slump, the perception of risk is amplified to the extreme. Investors, chastened by their losses, retreat to the sidelines, haunted by the belief in an unending market winter. Yet, paradoxically, it is during these times of despair that the seeds of opportunity are sown. With fear at a zenith, risk premiums and the potential for a market recovery reach their highest. In simpler terms, the endeavor deemed riskiest by the collective sentiment often bears the least actual risk, and vice versa. This insight was masterfully leveraged by the author in 2010, in the wake of the 2007 to 2008 financial crisis. As the construction industry languished, with housing starts plummeting to their lowest since the aftermath of World War II, an opportunity was brewing. Despite the bleak outlook, the underlying reality was that the 2010 population far exceeded that of 1945, hinting at an inevitable rebound in housing demand. What was markedly depressed was not the potential for growth, but the market's mood. The key metric, the ratio of housing starts to population, was signaling a future surge in demand, contrary to the prevailing sentiment that the housing market was doomed. Embracing this contrarian insight, the author and his team made a bold move, acquiring North America's largest private home building company. Their bet against the market's pervasive pessimism proved more than fruitful, underscoring the counterintuitive wisdom of investing. Sometimes, the greatest risks lie where the least are perceived, and the most significant opportunities where risk seems paramount. Part 6. The dual engines of long-term growth, labor and productivity. By now, you've been introduced to the whirlwind world of short-term market cycles and the lucrative strategy of situating yourself wisely within them. But let's pivot our gaze to the larger tableau, the secular trend of growth. This begs the question: if the underlying secular growth rate is positive, could one not simply set it and forget it, letting the whirlwind of short-term fluctuations neutralize each other over time while capitalizing on the slow and steady ascent of the secular trend? Here's where we encounter the more profound rhythms, the cycles within the secular trend that take much longer to manifest. Let's decode this through the prism of the United States Gross Domestic Product, GDP. GDP can be distilled to a somewhat simple formula: the aggregate of hours worked across the nation multiplied by the output value per hour. This dual mechanism suggests two main avenues for economic expansion: increasing the aggregate of hours worked or amplifying the productivity per hour. The straightforward path to ramp up the hours worked across a nation: boost the workforce size, which naturally links GDP growth to population trends. Reflect on the post-World War II era marked by the baby boom. As this generation matured into the labor force, the U.S. economy witnessed a surge, propelled simply by having more hands on deck, so to speak. This was economic growth fueled by an increased volume of labor. Turning to the second engine of growth, productivity per hour, the spotlight shines on technological innovation. Take, for instance, the Industrial Revolution's transformative impact in the late 18th and early 19th centuries, where steam and water-powered machinery began to take over tasks previously manned by human hands, elevating efficiency to new heights. Moreover, what once trickled out of small workshops now flowed abundantly from the fast-paced production lines of sprawling factories, thus propelling economic growth. Generally, the U.S. GDP has treaded a growth path of 2 to 3% annually. Yet, it's crucial to remember this is but an average, not a safeguard against prolonged economic downturns, which can last not just years but decades. Factors such as declining birth rates, due to wars, economic strife, or shifts in social behavior like the trend among young Americans to delay starting families, can diminish the workforce and, by extension, dampen long-term economic momentum. Thus, placing unwavering faith in perpetually sunny economic skies is a strategy fraught with naivete. The enlightened investor remains ever vigilant of the short-term cycles, ready to adapt and reposition as the market ebbs and flows. Final summary. The essence of mastering the market lies not just in understanding its current state, but in deciphering the repetitive cycles that command its flow. These cycles, guiding markets, economies, and the fortunes of individual companies, are woven into a rhythm of growth and fluctuation. In the grand tapestry of time, there exists a long-term trajectory of expansion, known as the secular trend, where growth is the general theme. Yet, within the chorus of this growth are the dynamic upswings and downturns, the market's heartbeat, pulsating around this central trend. The dance of these short-term cycles, marked by significant variance, is where the astute investor casts his gaze. The hallmark of a superior investor, then, is the ability to keenly observe these cyclical movements, to adapt and align their strategy accordingly. This investor understands the multifaceted relationship between euphoria and despair, between perceived risk and actual opportunity. By positioning their portfolio with foresight and precision, navigating through the fervor of booming markets and the gloom of downturns, they harness the cycles to their advantage. It's this intricate ballet of adjustments and alignments that distinguishes the exceptional investor, turning the ebb and flow of markets into a rhythm they dance to, leading to eventual success in the complex world of investment. Thank you for joining me today on this journey of learning and discovery as we explored the insights of another thought-provoking book in our growing library of knowledge. If you've enjoyed our time together, please take a moment to follow our podcast, give us a 5-star rating, and share 20-minute books with other knowledge seekers. Your support truly means a lot. Don't forget to join me again in the next episode, where we will delve into another enriching book. Until then, happy reading and happy listening.